I think we have a very, very, very frothy episode in store here today, don't we, Rob?
We always have this huge bank of topics, and then we only cover half of them because they're so good.
Well, that's true, but then also our good friends at The Real Deal keep pumping us with red meat, and we're going to eat it when it's, kind of whisked in our face like this. But here we are, nonetheless, excited to be back in the home studio with a normal setup. So for all the people who really like my typing on the keyboard when we do shows, especially in Riverside, fear not, that will be gone now. But we're really excited to be here. Of course, the Director of Business Development, Lone Star Capital, Craig McGrother. Hello, hello. Alongside the founder, CEO, the Houstonian, native, and local, Rob Beardsley. How are you today?
How do you spell Houstonian? Here we go. I'm doing
Is
well.
that even a word?
Yeah, of course it's a word.
That's what you call it, right? That's what I'm confirming.
Yeah, yeah, it's like Phoenician.
Because a Phoenix, precisely a Phoenix. I'm not a Phoenixan. I'm a Phoenician, which I'm actually
Absolutely.
really close to, very close to the Phoenician, as a matter of fact.
Yes, you are.
Well, we have a lot of fun stuff to talk about today, as mentioned as we went into the episode and the start of it. But with that said, quick couple shout outs. Number one, we have our incredible summit event coming up September 15th and 16th. I'm going to be a broken record and mention it until the event is coming on, and then I'll be promoting it for the next year after that. But once more, we have our summit event coming up in September 15th and 16th. If you're a capital allocator, you're looking to place money in deals and find people to work with, please come to the event. We've got all sorts of great people for you to meet that could be good partners, including yourselves, of course. If you are an investor, an LP, looking to find good people to work with, of course, there'll be great sponsors that just mentioned. And if you're an operator looking to meet new capital partners, you'd be foolish to not come. Do you have any comment on that as well? Because I know you got some choice opinions pertaining to that. Because you were like me at first, where you only want to go to events where there's networking, it's the focal point, and where you're actually going to meet good people and it's going to be curated and set up. So, can you dive into it for 1 second?
Sure. People who are high level that are worth meeting are difficult to meet. Networking is expensive. You don't just bump into somebody important or somebody who could be valuable to you without spending money. And it's a risk too. So there's never a guarantee when someone invites you to some trip or event or dinner and you don't know who's going to be there, and traveling or the dinner, it might be expensive and there's no guarantee that you're going to come away with something valuable, but that's just the name of the game of networking. So there's there's no way around it. Networking is expensive. Our event's expensive, but there's, I would say, one of the more sure ways to actually get a valuable networking experience that is intentional, where people are coming and the whole point is networking. So for someone like myself who networking doesn't come naturally to, it's really kind of, the event's built in a way that I would want an event to look, right, for my introverted self, and for someone like me who likes a straightforward, like, I don't want to walk around, shake hands, and small talk with you in hopes of stumbling on the idea that we should do business together type of thing, right? So I think the way that we come together as a team and as a group, and obviously our network is very uh, collaborative in that way as well to begin with.
There's some conferences you go to, which for some people this will not make any sense, but for some people this will make sense. There's some conferences you go to where it's like, I feel like I'm at Rush. I'm going around and I'm trying to meet as many people as I can to find someone that would be a good fit or to make sure there's a good spot for me to be. Our event, there are multiple times and experiences where you get to network with the entire people there. You're meeting the decision makers, you're meeting the heads, you're meeting the managing directors, not the associate below, which, with all due respect, that the associate below is the future managing director of tomorrow, naturally, or the future head of the family office tomorrow. But those people are there for you to meet with. So you'd be doing yourself a disservice to not be at the event and to kind of partake around that. And I've paid for more than this event for less periods of time, or for smaller windows that may or may not be a good event. And I've met one or two people. Such is life. That's just the way the cookie crumbles. I wish we could go to 10 of these events a year. I wouldn't have to go to any other events I do that for 5 years, half a decade, 10 of these, Lone Star-esque like events, if they were around, I would be done with my job. I would just call those people every single time and it would be good. So we're doing you a gift here. Give yourself the gift back. Take action. Go to the event.
Love it.
Cool. All right. Well, we'll harp on it getting next week. So I'm absolutely I'd like to take this time to apologize for absolutely nothing, as McGregor said. That said, also, kind of interesting coming up here. Just had a brief note. This will be released, of course, the following week when this is occurring. But this week, we have a bunch of earning reports coming out, which could be very interesting to see if we're going to get a rate cut, if we're going to get, stocks going down. I saw one stock's up because they acquired Chipotle. I think it was Starbucks acquired Chipotle, maybe. Interesting, but nonetheless, we are seeing all the earnings kind of coming out this week, or a big bulk of them. So, Rob, historically speaking, what does it mean for the market, for multifamily investors, and what we're doing here?
I really don't know. This is kind of the puzzle that I've been trying to solve in my head and understand, because a recession is good because it brings rates down, but a recession is bad because it's a recession, right? It's very simple. Recession is not good for the economy, and it's can't be good for multifamily fundamentals. If you are in the multifamily investment business and you're relying on positive rent growth, you're relying on the creditworthiness of your residents to be able to afford rent and continue to pay it timely on a monthly basis, they need to have jobs and they need to have savings. And right now we went from peak savings rates from helicopter money, stimmy money from COVID, to now we have no savings. We're back down to historical low savings rates, which are effectively no savings, and credit card levels are at all-time highs. So the consumer is not particularly strong, but the consumer hasn't necessarily been that strong in a while, and they've been already punished by rent growth, which is the core challenge of inflation. Shelter inflation makes up the majority of inflation, and then groceries and food and kind of your basic necessities have also gone up tremendously since COVID. So our renters, our target demographic, has already been struggling, going through a lot. So I just wonder, is what they went through kind of the worst of it, or is a recessionary environment going to actually now not just hurt them on a real basis, meaning inflation is eating away at their real purchasing power, or are we actually going to see substantial job loss, which leads to credit loss or basically uncollectible rent, which I hope not. And there's pros and cons to being in the luxury rental space or renters by choice. You have renters by necessity, which is pretty much what we exclusively cater to. And then also, the economy is not a monolith. There's different segments of the economy, right? Like in 2022, we saw a severe recession in tech, a lot of tech layoffs, and that bubble burst. And so if you were, let's say, renting Class A multifamily in the Silicon Valley, you saw rents go down by 10, 15%, and probably more if you factor in concessions. And that's because your target demographic were people that had jobs at Facebook that paid them $250K, and then those jobs disappeared. So that recession happened years ago. And so I'm just kind of wondering, in what shape does this recession, which I do believe we are in a recession at this time, like how's it going to take shape? Because on a macro level, yes, it's great because a recessionary environment is going to send signals to the Fed of, hey, it's time to cut rates. Treasury yields are going to trade down on the long end of the curve that are less manipulated by the Fed. So rates across the curve are coming down. We talked about the bull steepening a couple weeks ago. All that's happening on a macro basis. But what about the micro? What about residents actually being able to pay rent every month?
Yeah, for sure. And I think David Sachs said something that was really interesting on last week's episode of All In, which was you don't necessarily need to see stocks and bonds and prices just plummet down for us to be in a recession, which is really interesting to think about, which is like, hey, your dollar is just not lasting as long or as going as far. And, people are just generally speaking, not as well off as we were a couple of years ago, proportionally speaking.
Right. But then you have, for example, like our maintenance guys. Maintenance guys are making more money than ever. We're talking maintenance salaries have just consistently gone up and up and up and up, and our payrolls have gone up and up and up. So people that have skilled and unskilled labor type jobs, blue collar jobs, I don't know how much a recession is going to negatively impact those employees, because if we have a recession, are we going to lay off maintenance employees? I don't really think so. Uh, and if we did, I mean, certainly they'd get picked up by somebody else because those jobs are in just such high demand. So I think I can't say this for all lower paying jobs, because it's kind of like a funny situation where like lower paying jobs have so much demand because there's just an imbalance of the amount of people, young people today that stare at TikTok all day. They don't want to be a plumber, and they don't want to be an electrician, and they don't want to do manual labor, and they don't want to do all the maintenance stuff that we have. Just using that as an example, there's obviously more type of work that's available across many industries, but there's just less supply of those people, and the demand is ever growing, and it's not going to be just entirely done away with by AI. So even if we have a recession and people are not spending money as much, they're not going to restaurants as much, yeah, maybe hotels and restaurants, they cut back on hours so people don't, there's not as much work for those types of people, but I still think there's a strong pool of blue collar workers that are going to not even really notice that we're in a recession essentially, and just keep on going by. So yeah, it's very interesting to see how this is all going to play out.
Yeah, and it's interesting you mentioned that because when I was in Oregon, I go to Bend, Oregon, obviously several times a year to visit my family, and one of the most constant recurring themes that my parents say is just how hard it is for them to get workers, just on the property that they're on, but at the golf course is not too far away. This is a smaller market, but just little service stuff. It's just really getting more challenging, and a lot of people there are just collecting unemployment and other benefits and honestly aren't working. They make that comment very clearly. They harp on it. They have their own opinions on that, but it's very interesting that's there. And then you mentioned here how you can't find enough maintenance people. So it's a very interesting situation set up, if you will.
Yeah, and you just take the golf course example. Like in a recession, are people going to play less golf? Yeah, maybe. Maybe people are going to cut back on the amount of rounds they play because that's discretionary and they want to save some money. But are the people that play golf the type of people that are going to be impacted as much by this recession? Who knows? Very well possible. So it's like you just keep kind of peeling the layers of this onion, and that's why they call, I think that's what they refer to economics as being the imperfect science or something like that. But it's just so complicated, and there's so many interwoven pieces. But you'd have to imagine the groundskeepers at that golf course or any golf course, their hours probably aren't going to get cut down that severely. They're probably not going to lose their jobs. That golf course is still going to continue to operate. So those jobs are still there. But in
Well,
a
yeah, they're there
deeper
and they're strong.
recession, yeah, but in a deeper recession, like, is Facebook going to cut back? Is Google going to trim down, 1,000 here, 1,000 there employees? Probably.
Well, I made that comment. I don't know if it was on this show, if it was in private, but of course, being from the Bay Area and having us being both from there, which we'll actually get into an interesting article there. The people that got laid off from the tech companies that I saw were not salespeople, were not engineers, were not developers. They were kind of not really needle moving positions, just for the lack thereof, a diplomatic way to put it is they were, just not needle movers, not growing the company, and they got trimmed first. So that kind of makes sense. And I would say that's in line and in theme with who's getting laid off.
Yeah. And then just as an example, we're buying a property right now in the medical center of Houston, and 85% of the residents work uh, in the medical center. And so their jobs are in one way or another either closely or loosely related to healthcare. And healthcare is an extremely resilient industry, and it's just not as cyclical. So government and healthcare, those things are going to chug along. And I know they were harping on this on the All In podcast, which we're both big fans of, but the government now has grown so much in its not control, but its involvement in the economy, and their spending is what's propping up the economy. If government wasn't spending like it was, we'd be in a much bigger, deeper recession. And so
Well, the
with
private
that,
they mentioned exactly that the private market has been in a recession, but the government, with their spending and employing and hiring, has, as you mentioned, exactly propped it up.
right. So how does the government pivot, if at all, in a recession? In recessionary times, are they going to spend less? Are they going to spend more? because if that's already contributing to 30% of GDP, I hope I have that number correct, then that's 30% of the economic output of the country that is ostensibly not sensitive to a recessionary environment. I'm sure there's leakage. I'm sure there's a half truth to that, but a lot of our economy, and I'm not trying to like make a bull case here and say everything's gonna be fine and everything's great, but you look at government, you look at healthcare, you look at education. These are big parts of our economy that are not as cyclical. But you could take the counter argument side and say the U.S. is a consumer-based economy, and what drives our economy is people spending money. They're buying new Xboxes, they're buying Netflix streaming services, they're going to football games, they're going to restaurants, they're traveling. And if people are in a recession, like legitimately with what's going on with their wallet, and a recession is very much so a psychological thing too. People don't want the desire to spend, the good feeling associated with spending isn't there. So in a recessionary environment,
They cut back.
people cut back. And you could take that case and say, well, the US economy is a consumer-based economy and people are going to be cutting back, and that's just going to have a trickle effect all the way across the board, which I do believe.
Yeah, and I felt generally speaking as well, obviously I made the career switch from what I was doing here to what I was doing before, but I've had to drastically change my spending habits because to your point, I just don't think that there's these, anomaly scenarios where we're going to be creating money like we used to be before in today's economy and in today's market. 5 years from now, I might be spending like a drunken sailor in retrospect to what I'm spending with like right now. Right. So that just goes to show when the market was crazy, humming and frothy, dollars are flying out of my pocket at a totally different cadence.
Yeah, it's a psychological thing. Exactly.
Yeah. And you can create it a lot easier when, everyone's feeling good, sales are high. So there's definitely a lot of interesting stuff going on right now with the economy and the market. And, with the election coming into play, it'll only get crazier coming up. But just want to touch on the, data points there. And of course, next week we'll know the facts and what the market will react to it, and we'll react then accordingly. You mentioned something that you really want to hit on, which was types. Actually, no, before we get into that, the expenses. You actually had a very interesting lunch the other day with some big figures in the Houston area. So would love to hear your experience there. The A team was there, minus myself and Dasha. No, just kidding. But you, Kent, and Brad were there. So would love to hear how that went and the experience and what you achieved and what the goal was for that, time you guys were all there together. Because it's a big deal for you and Brad and Kent to all be at a lunch. So it must have been of utmost importance.
Yeah, we were invited to the Houston Housing Authority's compliance briefing luncheon, which took place on August 12th. That was downtown Houston. That was great to just get everyone in the room with the Houston Housing Authority and some of their key partners, advisors, counsel. Our counsel was there, our like special counsel as it relates to affordable housing partnerships and tax exemptions. And there was also other developers and sponsors that were in the room as well that were partners of the Houston Housing Authority. So it was just great to see kind of the main players in the affordable housing space for Houston and to kind of hear from people as far as what they're working on and what are ways that we can continue to provide and enhance affordability in the city of Houston. And it's a challenge. I totally get where the Houston Housing Authority is coming from. They obviously have a mandate, a bold mandate and a very much needed mandate to preserve and create affordable housing. And it's impressive what Houston has done. Houston recently received a $50 million grant from the federal government, and it was only one of 6 cities in the country to receive this specific grant for affordable housing. So it speaks to the efforts and the success that Houston is having as it relates to affordable housing. However, with all that being said, there's always hurdles involved as far as getting deals done, partnerships, getting the numbers to make sense, because although these are partnerships to do good, they have to do well by the numbers, right? They have to make financial sense. So everyone's trying to put the pieces together of how do we provide affordability while still making money, right? So that's a challenge, and there's a back and forth. So there was a spirited discussion as far as Houston Housing Authority's vision for their partnerships and how they want to structure deals, and other developers in the room were pushing back or asking for clarification and stuff like that. So it's just cool to be a part of that conversation, and obviously it's great to make a difference and to be such a strong partner to the Houston Housing Authority, which is something they emphasize. They view us, they view these deals that they're doing as more than just tax breaks that they're giving or pushing paper. Like, they view themselves as partners. They want us to be partners to them, and so it was all very interesting stuff.
How many groups were there? So how big was the room? How long was the agenda? Can you go into a little more detail there?
It was maybe about 50 or so people, maybe 60 people. So it was pretty small, I would say, for a luncheon. And I didn't know, like, there wasn't an attendance or an announcement or anything as far as who was in the room, but there was, some big names that people would recognize as far as national owners of multifamily, as well as people specifically who are big movers and shakers in Texas affordable housing. The agenda was
And
go ahead.
you go.
The agenda was mostly based around compliance, and so we recently had turned in the annual compliance worksheets and all this stuff, which is very labor intensive, and it's also a learning curve because it's a lot of new things and things that are being changed on the fly as far as what they want to see and the best way that they can kind of just oversee this compliance process of administering this compliance of, okay, are you actually creating affordable housing? Are you restricting the rent? Are you actually catering to lower income households and all these things? So it was kind of somewhat of a discussion, but also a bit of a, hey, we're announcing the new world order, take it or leave it. So it was, yeah, I can't share much more detail than that.
Fair enough.
I've already
We're all
shared
the
too much.
Yeah, we're all the partners, or I guess all the people, attendees, of course, outside of the Houston folks, like the city individuals. Were they individuals who had partnered with deals with the housing authority in the past, or currently, or moving forward? Or was the invite a private invite to all the partners? Can you just break down that, and then we'll get on to the next subject?
Oh yeah, for sure. Everyone who was there, who was a sponsor, were people that had done various types of deals. And again, I don't want to share too much specifics, but like typical affordable stuff that's going on in Houston, also including LIHTC and property tax exemptions and stuff like that. So that is, yeah, there were vets in the game, people who have done many deals, know what they're doing, asking good questions. And then of course afterwards, Kent went and had another meeting with a different housing authority. So we're staying busy.
Yes, and we will keep doing these deals as they come up where it makes sense. We do believe that this is, a win-win-win scenario where we win, our investors win, and the city and the housing authorities and the public benefit is achieved. So when we can have that, we're all very happy. On to the next subject, though, which is something that is a little interesting, which is something that you want to talk about, and I know nothing about this, so I'm excited, which is the type of expenses. Don't know more than that, but that's something you mentioned. You started talking, and I shushed you, and I said, no, we're recording because I want to hear this for the first time live. So, Rob Beardsley, get into the types of expenses.
So what I want to
It's
talk about
perfect.
are the three different types of expenses that one may have in a multifamily investment on your P&L. So, and one of them is actually not on your P&L, really. So basically, everyone's pretty familiar with operating expenses and capital expenses, or CapEx, OpEx and CapEx, right? And the big distinction there, as people in the lingo know, say above the line and below the line, right? And the line refers to NOI. So your typical profit and loss statement for a multifamily deal, or really pretty much any accounting statement, is going to be revenue, operating expenses, then you have net operating income. But that doesn't stop there, because then you have non-recurring expenses, one-time expenses, big expenses that don't really fit in your operating expenses, but are still real expenses incurred. And those don't go into your operating expenses, therefore they're not factored into your net operating income, and they go below the line, below NOI, which a lot of people refer to that as CapEx, but technically speaking, it's actually not CapEx. It's actually a replacement. So it's non-recurring it's replacements. And so that is basically an expense on your P&L, but it's not in your operating expenses. It's more like one-time expenses, but you actually don't capitalize them. They're not a capital expense, because a capital expense, something that you capitalize, technically goes onto your balance sheet and is reflected as an asset. So like, for example, if you were to replace the roofs and spend $1 million on all brand new roofs for your property, that's an you could capitalize that expense, and it's a capital expense, a capex, and that could go on your balance sheet. So you actually spent $1 million on new roofs, and so that capex actually goes on your balance sheet as an asset. It's an asset, right? That it goes towards increasing the value of the property. So trying to remember kind of what, like, the nuance that I wanted to share, but it's just interesting to think about. You've got these 3 different buckets of expenses, and there's not necessarily hard and fast rules as far as what goes where. It's kind of a judgment call. And so it's actually, one thing that comes to mind is one of our investors is asking about DSCR, and they're saying, well, what's the DSCR of this property right now, of this investment? And so DSCR, we've talked about many times on the show, it's your debt service coverage ratio. So the simple math on DSCR calculation is just your net operating income divided by your debt service, which your debt service is basically usually your principal and your interest payment, right? Whatever the cost is to actually service your debt. So if you have a property with $125,000 of net operating income, and in that same period you have $100,000 of debt service to pay your lender for that month, your debt service coverage ratio is 1.25. Now, that is a great metric, and it's helpful, and it's I love it. DSCR is great. The problem is, what if at my discretion and my accounting team's discretion, we have a ton of expenses in this period, and we say, no, those appliances and that HVAC repair and this waste removal, this pest control, whatever, all these expenses, those aren't operating expenses. Those are actually replacements, and those go below the line, so they don't factor into my NOI. So now my NOI, instead of being 125,000, is 150,000, or better yet, it's 200,000 of NOI, because I'm choosing. I'm not necessarily not saying this is illegal, not saying I'm being fraudulent, but those expenses I decided are non-recurring, and I put them down below the line in my replacements. So now my DSCR is 2.0x, and that's a eye-watering DSCR. Like, anyone would be like, wow, that's an amazing DSCR.
You're printing cash.
So well.
Yeah.
Like, you've got so much cushion, everything's great. So, and I'm not
actually,
trying to...
if you have a 200 DSCR, you need to refi some cash out.
Yeah, exactly. Like,
you need to pull money out.
Well.
Yeah.
You need to have more debt on the property. Yeah.
Yeah.
So
you need to grow your money elsewhere.
I'm not trying to invalidate the DSCR metric, but it's just, whenever you zero in on one thing, you're obviously not going to see the full picture. So it's just so hard, because everyone wants things to be simplified and just easily answered. And it's actually so funny, because I was actually with
also, if your DSCR is there, you're probably just levering your property up artificially higher, right? Especially on an acquisition of it.
Where you're saying, well...
Or you're delevering it, sorry.
Yeah, exactly. Like a 2.0 DSCR would imply, wow, you're under-levered. I mean, some people maybe want to run a 2.0 DSCR, but for real estate, depending on the real estate, for multifamily, it's very normal and acceptable, and lenders underwrite to a 1.25 DSCR, because multifamily is a stable performing asset class, so you can actually lever up. Now, if we're talking like an oil and gas investment, or if we're talking about multifamily in Midland, Odessa, which is out in West Texas, where they pump oil, drill for oil, right? Fannie and Freddie, they won't do a 1.25 DSCR. They'll size it to a minimum of 1.5, because it's a boom bust oil town. Like, you're not investing in multi at that point, you're investing in oil. So the lender has a completely different risk metric when it comes to those lending parameters. So yeah, I mean, the point is, with these different expenses and accounting is so complicated, and it's so hard to just look at one thing to determine if the property is performing well. For example, today I was with an investor and we were looking at some of our properties that we own together, and I'm not saying this is wrong or that they did anything wrong, but every no matter how savvy an investor is, and I do this too, the first thing, let me ask you, what's the first thing you want to know about a property if you're just trying to checking in on it?
The first thing I would want to know about a property if I was checking in, a new investment or a current investment?
Current investment, how's it doing?
How's occupancy?
Exactly. Everyone wants to know what occupancy is, right? And I don't blame them, and I do too. It's just like such a tangible thing. We want to understand how many heads in beds, right? The
Well,
problem with
also, it not only is it a tangible thing, but it also reflects upon, okay, is this management team asleep at the wheel? And that doesn't mean that you've got good tenants in there, which we can get into something like that later. It doesn't mean you have good tenants, but at least they're doing something. The property is at least attractive. You chose an attractive wife here. You chose a property that people want to live in for the price in a very fluid market.
Well, there you go. You mentioned so many things that can go wrong with just drilling in on occupancy, because maybe the occupancy is high because the rents are too low. Maybe occupancy is high because the on-site team is derelict in their responsibility of evicting, and they're just keeping non-paying tenants hanging around even though they're completely useless. Like I preach to my team all the time, let it be vacant. I would rather have a unit be vacant than be filled with someone who is not a good neighbor. Like we just don't need those people. So that's why we need to screen hard, and we need to make sure that we're only bringing in new residents who are going to add to the community and who are going to pay their rent consistently on time. So occupancy is a vanity metric. Like you can walk in and say, oh, well, the occupancy is 95. It's like, well, like, what does that mean? Because what if 10% of that occupancy is non-paying tenants? And what if rents are too low? And so on and so forth. So again, I'm not bashing occupancy, and I'm not bashing anyone who thinks occupancy is important. Occupancy is important. But the funny thing is, it's not the tell all. And if I were to kind of zero in on a tell all, I would actually zero in on collections. And collections is basically, it doesn't get any more simple than cash in the bank. How much cash did you collect for this month? And so in addition to occupancy, that's something that we are fixated on, and we're actually rolling out as we speak a new bonus program that the entire property team participates in. So the maintenance guys, the leasing agent, the assistant manager, the manager, everyone
So
participates in this
everyone's
team bonus.
incentivized to do the best and have good service. So it's an all or nothing. Very interesting.
Yeah, so let me share more. It's so cool. I love it
That's
because
I actually didn't know this. This is fresh news. I guess maybe I shouldn't miss out on town hall meetings.
no, I'm just too busy doing, and I'm not sharing. So
Yeah.
so with this bonus, like the maintenance guys, they understand intuitively that I need to get units ready for move-in, because the more move-ins we have, the more collections we get, right? And so the way that this bonus program works is the on-site team collects a bonus for every occupied unit that doesn't have a balance. So it does that unit, I don't count occupancy where they owe rent, right? So at the end of the month, we see how many units are paid up. We call them paid up units, PUUs. So we are looking for maximizing PUUs, because that's what I really want. I want to see the property fully
So
occupied.
paid. You're saying it very quick. So paid up unit, not PEU, not PED, PUU. Just so we're crystal
Exactly.
clear. We're
Yeah,
going
it's very
fast here. We're
similar
getting we're getting a master's degree here. Okay, and
in 2 minutes.
we need to break down this concept nice and smoothly.
Yes, agreed. Not a performance enhancing drug, not a PED, but a PUU. And the way that we do this is, here's the thing. Properties, not even properties, investors make money with that final amount of cash flow, right? So investors really make money not on the occupancy from 80 to 90. They make money from the occupancy being 90 to 95, 96, 97. For every point of occupancy that's paying above 95%, that is super meaningful, because it's like almost all profit, right? Because there's a lot of fixed costs associated with multifamily. You have property taxes, you have insurance, you have the debt service. There's a lot of fixed costs, and payroll is largely a fixed cost. So the majority of your costs are fixed, and that what that means is when you can squeeze out that marginal dollar of revenue, that's hitting the investor bottom line, and that's making the cash flow go up. So the way that we incentivize squeezing that marginal dollar revenue is we don't just pay a bonus based on the number of PUUs. We pay that bonus based on the number of PUUs above a minimum. So, like for example, if a property if a property is 100 units, and that means 90 units is 90% occupancy, we can set the threshold at 90 units. And if the property has units that are PUU units, paid up units above 90 units, let's say 91, 92, 93, 94, 95, for each of those units, there's a bonus. And that bonus is hefty. It depends on the property, but we're rolling out a bonus of around $300 per unit. So I'm talking 90 unit deal, which is very small. We don't really have any of those. So the bonus would be bigger. But if you have 90% paid up occupancy as the threshold, and they're at 95, that's 5 PUUs above the threshold at $300. That's $1,500. And obviously that's not a real example, because for our deals, we have bigger deals and we have bigger teams. So the bonus is more like $3,000, $4,000, $6,000 for the team to split. So it's a very meaningful thing, and it gets them understanding that, okay, I got to get as many PUUs above that threshold as possible. And it even works for lease ups. So if your property is not at 90% occupancy, or it's not at 95, if you're at 80, you just set that threshold down to 75 or 70. And so that way there's always, you can move the goalpost every month, and you can just keep adding more PUUs every month.
It's amazing. Well, it keeps everyone working hard and also keeps you motivated. Like a goal is really productive. And frankly, if you can make, a couple extra $100 here and there, that's not a nominal amount of money. And especially with a lot of the people too, moving forward, we're having a lot of folks who are workers, who are leasing officers, who are maintenance folks, who are now actually living on site with the discount as well. So not only do they get the benefit of knowing the community, being a key player there, getting discounted rent and then bonuses on top of it, that could really improve people's day-to-day and bottom line.
100%. And the property is happy to pay it, because think about this bonus structure isn't, I have to be careful with my words here, but hyperbolically, this bonus isn't costing us anything, because for every unit they're chasing down for the higher PUs above that threshold, we're happy to pay that bonus every time. Like my mom says, if someone came to you and said, if you give me $500, I'll give you $2,000, how many times are you going to give them $500? Over and over and over again, right? So we're happy to pay it. If their bonuses get obscene because they're 98% occupied and every single resident is paying, like, the property's happy to pay it. It really makes sense, and it works. So the last thing I want to say about this, which I know we kind of pulled on this string of yarn or whatever they say, like my dream is, so like a bonus only works if people understand why they're getting it. Like if I just came to you and I said, you know what, you're doing a great job, here's $500. You're like, well, I guess I'm doing a good job and here's $500. That's great. But it's really, a bonus is valuable when you know exactly why you're getting it. So my dream for this is that maintenance guys, who the majority of maintenance people in our industry, they're just kind of doing their thing. They don't really think too much about what's going on, right? They just know that they've got service requests to do, they've got ACs to fix, they've got units that they need to prepare for make ready, which for the people who aren't familiar with what a make ready is, it's just basically when you have a vacant unit, you need to prepare it for a new tenant to move in, you need to make it ready. So a make ready is, you might have to do flooring repairs, you have to do new paint, you have to maybe replace appliances if you have to, and so on and so forth, right? A make ready. So my point is a lot of times, if there is a bonus at all for maintenance staff, it's usually based on how many make readies they've done, or how many service requests they've done, or if they're closing service requests in a timely manner and things like that, which are great. Those are, like, I would say the most important thing in the world for us to be doing is to be completing maintenance requests in as fast as possible, right? Because that's how you get tenants to stay, and tenant retention is extremely important, because if a tenant renews their lease, you basically you got a new lease without spending any money. You didn't have to turn a unit, you didn't have to market, you didn't have to pay a leasing commission. Renewals are amazing. And that's another thing, not to get sidetracked, but I'm really emphasizing a new culture of renewals over churn and burn, new renters, try to raise the rent. Like if we can keep someone and not raise the rent or only raise the rent a little bit, that's honestly worth more than getting a new tenant in there at a $50 more a month rent or even $100 more a month rent. So just depending on how the numbers break down. But anyway, I got to finish this ramble with what I'm trying to say is I want the maintenance guys to actually
go as long as you want. Yeah.
I want the maintenance guys to see the bigger picture. I want them to storm into the office and go, all right, what's going on? Where's our PUUs today? Because the PUUs is a holistic understanding of the business. They need to understand that, okay, I better walk into this unit with this maintenance request with a smile and provide good customer service. Because if this person decides to stay, that's another PUU, and that's where my bonus comes from. And then, oh, we have a vacancy and we have a move-in. Well, we need to make that unit ready so that move-in happens successfully and that person enjoys and is happy with the quality of that unit. So that, guess what? That's another PUU. So it's like rather than trying to, like for me, like in your job, imagine if I gave you a bonus for every time you got up out of bed, and then another bonus for tying your shoes, and then another bonus for sending an email, and another, you know what I'm saying? Like, sure, that could work, but what if I just give you a higher level bonus?
I would be retired at this point.
Not if each bonus is only a penny, but it's much easier to manage and it's much more holistic, and it gets me and you on the same page if your bonus is more high level and it's like, hey, deliver what the company is looking for as it relates to closing new deals, bringing in new investors, and don't just bring an investor today, because then you could churn and burn. Think about the bigger vision, right? We're aligned on an equity, like you're an equity partner. So therefore you're thinking about, okay, I'm not just trying to like short-term trick an investor to invest into a deal I don't believe in, because that's not going to pay off in the long run, right? We need to have a bonus structure that incentivizes you and everyone else to think like owners.
Well, it's really interesting you mentioned the thought philosophy and perspective there, because I do take my word in the relationships I'm forging today, regardless if someone invests with us or not, incredibly seriously, because I don't plan to bounce around from shop to shop to shop, product to product to product, like a lot of people are in tech sales. With all due respect, people are in tech sales, but selling the newest version of snake oil, whether not just be in tech sales, but any business. And if you do that, you get a name for it. But if you do that enough, well, people aren't going to believe you or take you seriously. So when I call people and let them know that this is a good deal for XYZ reason, or why I'm believing this, or why I'm bullish, why we're doing something, while we're not doing
Why
something,
you're putting your own money
that's
in.
very important to me. I consider that I take it very seriously. And also, I'm not in the business of wanting to speak with people to do one-off business with them. And it's kind of funny. I actually spoke with someone I went to high school with today from some of the campaigns we're doing on LinkedIn. I messaged them, and then 6 months later, they messaged me back and had a conversation. It's like, I'll be honest with you. Like, if you're ready in 10 days, I'm really happy, and I can brag to Rob about it and the team about it. If you're ready in 10 years, I would be happy then. It's really when you're comfortable. I can't pull the string for you there, so to speak. I can't tell you when it's ready for you. This is all about you and your experience. And I think people really gravitate towards that. And it's funny, I actually spoke with 3 people today from who listened to the show in one medium or another. And both of them said that it was very, 2 of the 3 people I think mentioned that it was very spot on with how I spoke to them as to how I speak on the show and all the channels and stuff, which is very happy that we're coming off authentic as to how we are, because I don't think we're putting on any sort of an act. But over the course of time, the authenticity that we pay today, the work we put in today, and the right that we're doing today will pay for our tomorrow.
Yeah, very well said.
So it's the aligned and honest interest that we put in here, and how serious we take it is so crucial. So, question for you: how did you kind of come up with the logical thought process that we're in now, and how are you kind of conveying that as we go through some shifts on, certain, human capital people for specific properties? What was kind of the opportunity, and what was the aha moment to come up with this new kind of compensation and kind of structuring from a management perspective?
We had been trying a few different bonus structures, and we have a few different ones in place across different properties, which gave us trial runs and an ability to kind of see what's working. And there's pros and cons. Like some are harder to administer, and we have to kind of track more data and stuff like that. And that's kind of what I love. I love Occam's razor. I love the idea that the simplest solution is the best solution, and having a holistic team bonus, which I'm always a fan of team bonuses because I don't really love individual bonuses all the time. I prefer team bonuses. So we kind of started putting the pieces together, narrowing it down, and the big aha to me is just with Ina and her properties, she has been doing this PUU concept, but it didn't click for me because I had this concern that it wasn't motivating the marginal collection, because she had it based on total PUUs. So for every paid up unit, you would get a bonus. But then it's like, why are you getting a bonus for the first 10%, the first 20%, the first 50%? That's table stakes. Like that just barely pays the expenses, right? We're talking profit, right? And so to me, that's where we took this bonus concept to the next level by introducing this threshold concept, where there's a threshold that you have to hit, and then after you have that many PUUs, every unit above that threshold, you're making big money, right? And that way the property and the on-site team are aligned in going and chasing after that last dollar, because I want the on-site team to be hungry. I want them to be staring at that delinquency sheet and they see resident 202 such and such, and they have a balance of $800. So they owe $800, and it's like, I need to go and collect that $800 because that way our team gets $300. Like, it's kind of funny because let's say someone has a balance of $100. It would make sense for the on-site team to go and pay that person's rent because they would get a $300 bonus, right? They would net $200. So not saying that's kind of the intent of the bonus, but it's the simple fact
Well, you can
that, like,
sandbag it a bit, right?
well, you can. And it's also like, guys, why are we just allowing this person, not saying this is like any individual or any property, but why are we letting this person have $100 balance? Like, if we've got $100 to collect, let's go and collect it. But you see, if it's just a percentage basis of the total, the team could get complacent and be like, well, they paid most of their rent, $100, whatever. Let's let it roll over to the next month and we'll deal with it. And, little problems become big problems. And if we have a culture of we're collecting every dollar, and it's not just because we're hounding them, this bonus structure just naturally does it, right? So that's how we arrived at this concept.
Very cool. So is this now trickled down through all the properties in the portfolio?
August is the first month that we're rolling out this bonus.
Very cool. Very cool. Well, any other thoughts on the other types of expenses? Because we went on a massive side quest here, which was very entertaining and very informative. But on the type of expenses, have you fleshed out that? Have you exercised all your demons, or do you have anything else you want to hit on?
I think it's good.
Okay. Very good. Well, final topic we're going to talk about, because as you, of course, led the way with, actually, we did go.
I stole the show.
No, I think the audience would all agree that when you steal a show, it's probably a better show. With that said, Silicon Valley, an article came out on The Real Deal that the average house now, typical home now tops $2 million, becomes the first metropolitan market in the U.S. to enter double $1 million club. That is freaking nuts.
It's nuts. And it's a microcosm, right? Silicon Valley is a bit of a bubble, but it's not the only place in the country that's where single family prices continue to grow. And that's the thing. I don't know. Like, I just wonder, is the single family market just that resilient and that it's just going to keep on chugging along? Or is there a day of reckoning that's coming? And is this recession that we're basically starting now, is that going to impact single family home pricing and bring a bit of a reversion to the mean as it relates to the delta between homeownership and rentership? Because right now it's come down a bit for sure with treasuries coming down. But when treasuries were at their peak 6 months ago, 12 months ago, whatever, we had the widest gap between renting and homeowning ever, right? Basically, homeownership was as unattainable as ever. So that's great for our business, but it's a sad commentary on American life and the economy. So anyway, that's kind
great.
of...
Yeah, it's great for the business of Craig McGrother, because I somehow I thought I bought my house literally at the worst point, because rates were increasing at the market high in 2022. I sold it 2 years later to take advantage of the sweet tax opportunity of basically selling your gains tax free on your profit up to $250,000 as a non-married individual. 500K if you're of course, married couple there on your equity on the appreciation of the property. So, I sold that, bought a house at the market rate high now, but, it's very crazy. I mean, dirt lots in Arizona. My house is basically rendered lot value. I actually got an incredible deal on it. But they're basically selling for $750,000 for a piece of dirt in Arizona. That's, 10,000 or 6,000, 10,000 square feet. That's nuts. So things are very expensive now. And as I've said before, and I'll say this again and again, I don't think this problem is getting actually any better. I think this is a temporary blip, and pricing is probably about to get crazy soon as well. Obviously, if a recession hits and if it's nasty, of course that could affect pricing, but that's not going to change the fact that for the large swath and bulk of people who have properties, if there's any debt on the property at all, any at all, it's going to be sub 4%. Most people are not trading out of 4% loans, or they'll keep it as a rental, they'll keep the property, or they'll tap into a home equity line of credit, which is not a refinance, but it's you could pull off, home equity line of credit. Let's say you've got, some solid baking at the deal. A lot of people's properties almost doubled in value since 2020, which is nuts, or probably really, depending on what market you're in, 2020. If you're in the Bay Area, probably 2016, which our article is referring to. Your home equity line of credit, if you want to, play elsewhere, you want to arbitrage it, you do whatever you want to do, is a variable rate, basically whatever, the interest rate is at that time. So people will probably take out a HELOC to do, some fun maneuvering there before they sell their property, before they refinance. The only people that'll be refinancing coming up here will be people like myself who will refi into, longer term debt once I complete some sort of value add project to my property, and I'll get probably all my equity cash free. And that's really actually the goal, is to do a big project on this and probably do the cycle again, buy it, fix it, sell it. Or if it's a really frothy environment, maybe refi my cash out and put into more Lone Star deals, of course, naturally.
I was going to make a joke about, you were talking about the 250K tax-free personal residence sale, and I was going to make a joke about, like, well, according to our listeners, you have a $10 million trust fund, and I would imagine that your daddy got you like a $10 million house and that your capital gain was $5 million.
Dude, I wish I was that rich. That would be so cool. Like, my life would be so much more easy. No, but in all seriousness, I would love that. I really would.
Me
But
too.
regardless of that or not, I'm still going to Bandon Dunes soon. So life's good.
Yeah, I guess it's better to appear rich than to be rich.
Right. Well, I do live in Phoenix, Arizona, Scottsdale, Arizona. So, that's really in vogue here, like it is in Miami or Los Angeles, of course. But seriously, it really is interesting, though, that the Bay Area is expensive. And what's also fascinating to me as well is the heinous cap rate, if you will, on single family houses and really multifamily in the Bay Area. But it is absurd. Okay. The houses in just the neighborhood that my parents own a house, which has done very well, the ratio of the price to the rent actually made me throw up. And it would basically be the tune, to not exaggerate, the property taxes, if you bought the neighbor's house next door, would exceed the rental number that it's renting for right now.
And taxes are not high in California.
They're not Arizona cheap. They're not low.
They're not Florida and Texas.
They're not someone else we know.
Yeah, absolutely.
But it's not that expensive. It's not getting reassessed every year, like your point. It's one of those things where it's also locked in, though, as well, when you buy the house, which is nice. So you're kind of grandfathered in at that tax basis rate, which is beautiful, but it also stifles transaction volume, because my grandma would have sold her house, years ago if it got reassessed to what current value is today. So that really is an interesting factor, that those variable costs are a lot more fixed. Now, the problem people are having, though, in California and in the Bay Area is insurance is getting out of control. A lot of carriers are leaving the state, which is making it very challenging. My grandparents live in the Oakland Hills, and they're struggling to get anyone to give them a fire quote for fire insurance, which, get last you check, if you Google California natural disasters, there's, a nasty fire every single year, of course. So Yeah, this is just
Insurance is
bonkers though.
a
But
boondoggle. Yeah,
I
insurance is
would
tough across the board.
I'd rather die than live in the Bay Area for a $2 million price point for what it buys, because my sibling bought a house in the Bay Area. He bought it in Santa Cruz, and my mom was like, "Oh, look in Los Gatos," and it's like, "Mom, do you realize what the base lot in Los Gatos looks like and costs? A lot is almost $3 million in Los Gatos. So this is not 2007.
This is not
You
your
know,
baby boomers economy where you find a dollar bill on the ground and buy your starter house and then look up 40 years later and it's $3 million.
oh my God, I own in Crescent Park in Palo Alto. That's so funny. I bought this thing for 300 grand. It's worth 10 million now. Isn't that amazing? Yeah. Well, you guys
See,
soaked up the
kids,
real
it's
estate.
so
That's
easy to
great, and you're
save for
not selling it
retirement.
either.
Yeah.
Yeah.
The other
It's
thing
so easy to get rich.
yeah, exactly. Yeah, it's like, see, just do it like me. Just save for retirement like I did. So
Yeah.
the other interesting point about single family home pricing and stuff like that is the fact that like I was talking about, you got the ad for the FootJoy socks.
And
We
the
got to let
Amex
everybody
too. It knows I've been
we got to
greedy.
let
Yeah.
everybody know on the podcast that the Lone
Wait.
Star
Actually,
Capital.
want to do a little shoe show?
Well, I mean, I wanted to do a sock show. I wanted to talk about the official Lone Star
Ah.
Capital socks, which are those FootJoys, the Pro Dries there. Those are
By the way, I am wearing pants for everyone who's wondering. When I do recordings and stuff, I am wearing pants. I actually have a very nice outfit looking right now. But look at these new, and yeah, I am that flexible. Look at these new Ralph Lauren loafers. Those are suede, if you were wondering.
yeah, those are great. Those are great for your wide
Yeah,
foot,
I
especially.
love them. Yeah, yeah. Sorry.
Well, we're happy you're happy. But anyway, in all seriousness, on a very serious topic, if people are interested in finding the best no-show socks, just hit us up.
Yeah, if you want to know the best sock, you have to email me. It's craig@lscre.com for all your real estate needs and socks needs.
Yes, correct. So obviously you always come to this podcast to learn the most, and we deliver. But on the single family home front, I was kind of arguing about, is there perhaps a reversion to the mean as it relates to home prices coming down in relation to rent and kind of normalizing a bit? And then you're saying, and I'm not saying you're wrong, but you're saying the opposite, that this is a blip in time and that this trend is just going to get worse and worse. And I do believe you, because I do think that this pricing activity or this dynamic is a result of the divide between the haves and the have-nots growing. And that's exactly what we're seeing, right? We're seeing the disappearing middle class. We're seeing the haves continue to get rich. The have-nots continue to struggle. And that the manifestation of that in the housing market is you've got a few people that own all the real estate and then everyone else rents, right? And that's the challenge. It's good for our business, like I said, but it's a bad commentary on the American economy. And also the really important thing I wanted to say.
American economy. Yeah, the American economy and dream is just shifting in real time, which is unfortunate. I mean, it's just an antiquated way to think about it. So I wonder what that will look like moving forward. But the scary thing is that due to the shift and whatnot, it makes everyone probably less prone and less comfortable or confident with the idea and desire of actually having kids and a family, because they can barely keep their head above water to start with.
That's a whole other can of worms. Yeah, unfortunately. But if you look at home prices globally, and I wish I had this data at my fingertips, but our friend Patrick was showing us this data a while ago. If you look at home prices relative to annual incomes, so if you look at median home price versus median income for different countries, America is actually very affordable from a home ownership standpoint. And again, I'm totally blanking on the numbers, but let's just say that the median household income in America is, to make the number simple, $70,000. And let's say the median home price is about 8 times that, which that probably makes about sense, like about whatever that is, 600 grand, or I can't do math. But if that's 6 times in America, there's examples across the world, like Germany, like Paris, and also it was actually by city, not country. But it's like, what, did I do something really bad?
No, it's just funny. I can't do math. That's really what our investors want to hear.
It's okay. I have Excel.
Seeing as that this is all a math equation itself.
It's all a big math equation. So, so if it's like 8 times in America, there's actually like Paris, like Munich, like Moscow. Like Moscow, I remember was 22 times the median household income was the average home price. So that would be the equivalent of the average home in America being 2 million. So it'd be like Silicon Valley, but the whole country, right? So that's how unaffordable home ownership is in many other places in the world, actually. So we are complaining today about the dynamics of the American economy and the affordability of home ownership, but it's way, way worse in other places. So it's very reasonable to argue the fact that the affordability of owning a home in America was in fact just a blip in time, and that the golden age, the halcyon days of American exceptionalism of post-World War II created this aberration where there was a middle class. And then if you just look all throughout the hundreds of years, thousands of years of human history and modern economies around the world, there really isn't many examples of a middle class that was as prosperous as that period of time in America, where the majority of the country owned a home, right? Because if you look at how economies have come together throughout history, it's been royalty or the king or the kingdom or whatever, like the aristocracy, the elites that owned, the minority that owned everything, and the majority that owned nothing, right? So I'm not saying that's where we are, that's where we're headed, but it's kind of looking like it.
Well, if you follow Ray Dalio, who's a little bit too pessimistic and cynical, in my opinion, about the falling empire, we're going to fall and we're going to make money, blah, 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 and you get the YouTube ads like me, you would say, oh, well, we are heading towards that, and it's a matter of time. So, buy the real estate now and hold it and pass it on, because real estate is such a transferable asset. That might be within your best interest if that's still available in, the decades and years to come.
Yeah, and then just make sure that you buy a few watches so that if America does implode, that you can just put a long sleeve shirt on, put your watch collection up your wrists, slide your sleeves down, and now you've got $1 million of watches on. You just jump on a plane and you're out, and you can start a new life.
Yes, exactly. That or Bitcoin, I suppose, right? For all those who are listening today, thank you so much for tuning in. We will get into the frothy and juicy articles we had next week. Hope you enjoyed the side tangent, and we look forward to seeing you then. Peace.